Welcome to WealthWise with me, your host, Jordan Kimmel, and we have a great show planned for you. I've always talked about different experts coming on with different points of view. We're going to bring on Wayne Thorp from AAII, the American Association of Individual Investors. And Wayne has a special way, a special reason to have his finger on the pulse of what style is working in the stock market. And we'll talk about that in just a couple minutes. I wanted to spend a couple minutes before we bring Wayne on just to talk about a couple developments. Um, CrossCheck Media, great partner who is producing these videos, has also started releasing a week ahead note. And we came out with that, for the last several weeks. You might want to look at that, find a way to subscribe to it ahead of next month, where we'll actually be releasing a newsletter with several experts, all sharing their monthly advice. And we can't wait to issue that. And we're really looking forward to it. In this week's edition, I want to just really important set a stage for something that is obvious to a lot of technicians. It has a lot of people scratching our head right now. What it is the indexes, the S&P and the NASDAQ, at brand new all-time highs, with the advanced decline line not only faltering, but breaking a 52-week low. We're seeing more 52-week lows than new highs on NASDAQ. Folks, there is a vacuum or a black hole where all the money's being sucked into just a few names. We've seen this before. They called them the Four Horsemen in the year 2000, until a tremendous sell-off, which will let really a whole generation of investors scarred. We've seen it in the Nifty 50. We're seeing it right now. And not only are there some house favorites, but I want to just talk about the energy, if you will, of the market itself. About a month ago, Apple, everybody's favorite from a year or two ago, was literally left for dead. The fundamentals have actually deteriorated significantly. They do have a billion installed, they call base around the world. But what happened was the revenues were faltering. It really looked like has been, if you will. And then suddenly, and we said this a couple of weeks ago in the weekly note, that Apple was going to do their AI meeting. It was going to incite and excite the market. But what happened, folks, is Apple put on, you got to understand this, $750 billion in market cap as soon as the fuse got lit. The 750 billion in market cap is equal to, and then we're not saying the size of Apple, we're saying the increase in the market cap within 1 month's time. It's equal to Tesla, what some people feel is one of the most important mobile technology companies in the world, for automated driving coming down, and on and on and on. It's equivalent to Tesla, Boeing, Cisco Systems, and Intel all rolled into one. That was the increase in Apple's market cap in about a month's time. It's almost unbelievable. Once the market decides to like something or not like something, there are bots that just run wild. There's no care for valuation. There's no care for much of anything. It's the bots running wild. And I want to point out one more just quick concept. And we're going to bring on Wayne, which I'm looking forward to. Be a great conversation. But I want to point out that it was only a couple of years ago that Tesla, or let me go back a second. It was only a couple of years ago that it was Nvidia. Nvidia lost about 70% of its market cap on a vicious sell-off. You didn't really hear too many people saying Nvidia only, Nvidia the darling of my life, Nvidia, I can't get enough of you. What we saw was dramatic wholesale selling, and I said it's 70% down in value. Well, the concept, if you will, that Warren Buffett subscribed to, that he learned, from the master, of all in terms of value investing, the concept was called Mr. Market. And Mr. Market gets very grouchy sometimes. And Ben Graham, who really invented this, he was a fundamental analyst and fundamental investor. But the very, very same company, when the market loved it, you couldn't get enough of it. When the market hated it, they just kept selling it. What he talked about is using the emotions of the market, understanding what you're investing in, and buy it when they hate it, and maybe sell it when they're chirping and they can't get enough of it. Same company, same exact history, same management, same almost everything, from down 70% in a calendar year to the love of everybody's life. Just be careful. Don't invest emotionally. Valuation really, really matters. And my take is, when I said in this week's piece, we see dozens and dozens of really great looking magnet and fact stocks and setups and charts. Folks, that's in a sea of thousands. And when the advanced decline line deteriorates like this, it takes the good girls with the bad girls. Have some cash ready. I'm not calling for a crash or a bear market. I'm simply saying, use your head, let the tide go out, gobble up some value. Don't be chasing what everybody loves and everyone's talking about on any given day. Well, that's enough for me right now. Let's take a real quick break. Wayne Thorp and AAII is one of my favorite groups. I've known Wayne for a while. Let's take a quick break and see what's on Wayne's world and what's on Wayne's mind. We'll be right back with more market wise, more wealth wise, right after this.
Watch 13 Wham News anywhere on any device with Stir. Download the Stir app and choose Rochester. You get local news and more than 20 other TV channels. And the best part? It's free. Go to your app store and download Stir today.
And welcome back to WealthWise. To be your host, Jordan Kimmel. And it's really a delight right now of bringing on an old friend and colleague. And it's Wayne Thorp from AAII. That's the American Association of Individual Investors. Wayne, thanks so much for joining us.
Oh, it's a pleasure to be back, Jordan. It's great to see you.
Well, Wayne, I'll talk about our history. And Wayne, you're one of the few guys who's so powerful. You've got two American hero names. And so you are a hero of mine. What I want to talk about is American Association of Individual Investors. Let's talk about that whole platform, and then we'll dig into your specific role. If I'm not mistaken, it is America's largest group of individual investors on a platform. And maybe you want to talk about the history and a few pieces of what you guys offer.
Sure. Yeah. So as you said, AAII, we're a nonprofit investment education membership association. We were founded back in 1978 by James Clunan. At the time, Jim looked at the marketplace and discovered that for individual investors, there was really no source of independent investor education. If you wanted stock information, you were going to go to your broker. They had an agenda. They were trying to push whatever their research staff was coming up with. So Jim had tremendous forethought and came up with AAII to provide unbiased, evidence-based investor education. And so we started out, literally Jim started out from his kitchen table, putting together our journal and everything like that. But at our heart, our goal is to provide individual investors with the tools and resources that they need to become better managers of their own money. And we do that through publications. We have our flagship AAII journal. We are evidence-based, so we're always looking for the latest academic research that we can then translate into actual practical real world tools, strategies, etc. We have a website. But then over the years, as we discovered that our members, they don't necessarily want to spend the time to learn how to do investor education. They want to be more directed. We've started launching premium portfolios. So we have portfolios that look at a collection of investing gurus. We have a factor-based portfolio. We have a value/income dividend portfolio. And then we also have a growth investing portfolio that I launched back in October of 2022.
Right. And, I was on the site just a little while earlier, and, not only do I love the site, folks, I am a lifetime member. As soon as I saw it, I said, let's just pay the lifetime membership. I realize now, there's a few extra premium things, including your portfolio. Looks like I need to spend a couple more dollars. I'm sure it's going to be, all the worthwhile, and I look forward to it. And, I want to point out too that Wayne, you have before COVID came out, your meetup rooms all around the country, different cities, really allowing people to share ideas and really share a network with each other, which I loved. And I've spoken at maybe 6 different cities. And what I point out here is not only are you guys do it yourself, or so to speak, but there's a real engineering background, and I think that the members themselves, a lot of them are very well to do. They don't want to pay advisors, but they have a engineer slant, and they love the actual the models and the systematic, like you say, evidence based. So here's what I want to bring up, and I'm going to let you introduce it, but I'm going to tell you how I used it as a tool to help literally hundreds and hundreds of people that came to see what I was doing at Magnet. Talk for a minute about the Guru's model, or the 60 so on models that come out every single month, where you show, well, I'm going to let you describe it first, what it's about.
Sure. Well, and one of the things about AAII is we recognize that there's no such thing as a one size fits all approach to investing. Everyone has different time horizons, risk tolerances, motivations, etc. So what we do, sort of going back to the discussion of evidence-based investing, is, I've been at AI now for 27 years, and I have looked at, literally dozens, if not hundreds of different investment strategies and methodologies. And what we try to do is we have a fundamental stock screening engine called Stock Investor Pro. And what we do is, whether it's an academic paper, an article written in Forbes, a book that's come out, we will take a strategy that's outlined that is more rules-based, and try to adapt that strategy for our stock investor software. As the internet and everything has evolved, we've now moved this engine to an online base. So on a daily basis now, it's not monthly now, it's actually on a daily basis.
Okay.
We track, now we've scaled it back a little bit. We have about 50 or so of these stock strategies that are more, factor based. So, pure low price to sales, low price to free cash flow. But then we also look at, some of the best investors of all time. We have a myriad of Buffett screens, William O'Neill, his momentum and growth strategy, Jim O'Shaughnessy, we have a few of his approaches. But we provide all of these. It's not a black box system, so we provide a very in-depth article describing the strategy, what the motivation and the rationale is for the different criteria that this individual might have used. And then we provide the actual rules that we are applying to our stock universe. And then on a daily basis, we run these screens, and you can see all the stocks that are passing a given methodology over time. And then we also provide simulated performance statistics, so you can see how a strategy is performed, over the last year, 3 years, 5 years. I think now at this point, it's over 25 years. And it's, the benefit of that is you're able to see how these strategies perform over different types of environments. You can see how a strategy performed when the market crashed during the COVID, how it performed during the Great Recession, the financial crisis, and things like that. So, we're not advocating necessarily a given strategy, but we provide the data, the information, and the rationale for the individual to decide, oh, this is an approach that has performed well over time. It fits, my personal tastes, and then they can take that and actually invest it themselves.
Yeah, and that really to me it blew me away what you were doing. And to tell you how I was using it, I've had about, at Magnet Group, I've had literally 100 different interns from some great schools, and every time they'd start, they said, "What do you think? What do you think?" I said, "Well, you should read my book, Magnet Investing, brought value, growth, and momentum together." But when you go on the AAI screen, Wayne, you do such a great job outlining the factors that go into growth, the factors that go into momentum investing, the factors that the gurus or experts were using. And I'd have the intern say, listen, you can't follow anyone else's approach. You have to understand who you are. You have to understand what works for you, and just because, say, value or growth is working today, that doesn't mean you switch horses, but it gives you great insight to what's working now, why it's working. Wayne, that page and the idea generation that came off that page. And before we take a break, we're going to get into next your growth strategies, the other thing that AAI offers. And just I'll mention, not only am I a lifetime subscriber, there's some articles that I've written, up on your site. I've been on your screening before. I want to get back on it again. We'll figure out how we do that. But what we're going to do when we get back is look at the other features, the other portfolios, the premium services. We are with Wayne Thorp. It's AAII, American Association of Individual Investors. Probably the easiest website to look at, AAII.com. We'll be right back with Wayne following the break.
Like the Kentucky Derby, Woodford Reserve Bourbon is a spectacle for the senses.
Welcome back to WealthWise. It's Jordan Kimmel, your host. I'm here with Wayne Thorp, and Wayne's from AAII, some people call it, the American Association of Individual Investors. And Wayne, the 20 some odd years you've had there, you've been exposed to really the top investors in the conferences you put on. You've kind of seen, everything, and we all go our own ways. You actually gravitated and created this growth strategy. I'm really interested in why, how, what. Tell us what it's about, and what the portfolio looks like, maybe how many companies, some factors, and what's the turnover look like.
Sure. Yeah, I mean, I would say AAII as an organization definitely has more of a value slant. And the main reason for that is, there's a ton of academic research that shows that over the long term, value outperforms growth. And so, we go where the research shows us and what the data shows us. And so, we started talking about, we were looking at our portfolio of products, and our members were asking, I'm more of a growth oriented investor, so what do you offer? So that's what spurred me to start looking into an approach. And the AAII growth investing strategy, just like all of our others, is an evidence-based approach to selecting growth stocks with strong potential future growth. From an academic standpoint, when you hear the term growth, oftentimes that is stocks that either have low market to book values or high price to book values. Basically they split the universe. You've got low price to book is the value universe, high price to book is the growth universe. And the valuations of these high price to book or quote unquote glamour stocks, it's really driven by the high expectations that the market holds for these stocks. And so, expectations are going to drive these to high valuations. However, the same research often shows that in real world experience backs up the fact that just investing in high valuation stocks tends to be a losing effort over the long run.
Right.
And primarily this is because of mean reversion. A lot of these stocks that have high valuations are high growth stocks. They are actually showing high levels of earnings growth, sales growth, et cetera. But the marketplace, there's companies looking around and saying, "Oh, look at that company over there. They're growing really well. They have high profitability. Let's get into their marketplace." And so, through competition, as well as just as companies get larger, it becomes more difficult for them to keep growing at those very high levels of growth. So over time, that growth, either through competition or just sheer size, those growth rates start to deteriorate. The problem is for high valuation stocks, as these growth rates start to diminish, the market has to readjust its expectations. And in doing so, you often see a pretty significant adjustment in stock price. So that is why over the long term, quote unquote, growth investing doesn't tend to perform as well as value strategies. And to highlight this point, when I was researching the growth investing approach, I just took a single factor, 5-year revenue growth, nothing more, nothing less. And I broke the universe of stocks down into quintiles and looked at the stocks that have the top 20% of 5-year sales growth rate, the lowest 20%, and over a 25 plus year testing period with just annual rebalancing, what I found was the companies that were in the top 20% of 5-year sales growth actually performed more poorly than the stocks that were in the bottom 20% of 5-year sales growth rate.
Oh,
that just blew me away. And so, what led me to is I actually looked for one of the things I'm looking for with the growth investing approach are companies that I call sweet spot growth. These is kind of like, you can call it also Goldilocks growth, not too high, not too low, middle of the road growth that a company is able to sustain over the long term. So the market doesn't have to make those adjustments to their expectations that then often lead to a significant drop in price.
Right.
So what the AI investing approach that I created really is attempting to counter those traditional pitfalls of growth investing. And so, these companies often, I also call it, it's called secular growth as well. And what these companies, they often offer a product or a service that the demand really stays relatively stable no matter what the market environment is. It's a must-have product or service that it might there might be some slight valuation adjustments based on the economic cycle, but by and large demand is going to stay stable no matter where we are in the economic cycle. So that was really the overarching attempt of what I call to be growth investing done the right way, and so finding these companies that are growing at a sustainable level. But the other element of that, which to my knowledge, there's really no other strategies out there, is also make use of what's called the G-score, which was developed by Partha Monraham, and I apologize if I mispronounced the name, but he's at the University of Toronto. And he took and performed just pure accounting analysis of companies and came up with this 8-point G-score, which separates high growth potential stocks from those that are just truly overvalued. And so it's 8 criteria, and it's broken down into 3 categories of profitability, stability, and accounting conservatism. And his analysis, as well as the analysis that I performed, also shows that companies that have a high G-score, these are companies that have behaviors, spending patterns that tend to allow the company to continue that growth going forward. And so companies that have higher G scores over time outperform those with lower G scores. And then lastly, it's all about quality. So we overlay our growth score, which is again the stable growth, high G score, and then we just look for companies that have high levels of financial strength and stability, high quality, which is just offering another layer of safety for the company and investors.
I love that. I mean, you're speaking my language. It's this, multi-factor model that blends together, and again, just because you think it might work, how about testing it first? How about really some empirical evidence? So I love the approach you've taken. Wayne, give me an idea. So you did the back test on an annual rebalancing. How often do you actually rebalance it?
Oh, we don't do active rebalancing. No matter what type of investor you are, no matter what type of strategy you're following, I strongly suggest that you have probably your set of criteria that you're using to base your buy criteria off of. You should also have a very clear and defined set of sell criteria. So basically,
Hmm.
at the time that you're buying the stock, you know that if it does this, and or this, I'm going to sell it. It removes emotion, it removes ambiguity. So we have a very clear set of rules on the buy side, and I have an equally well-defined set of criteria on the sell side. Since the inception of in October of 2022 on a 20 stock portfolio, I've made 3 changes to the portfolio. So this is a very long-term portfolio. Actually, I've gotten a little pushback from our subscribers who I think are maybe looking for a little bit more of a trading portfolio. So they're saying, there's not a lot of turnover. It's like nothing is triggering our sell criteria.
Let them look elsewhere. Let them look elsewhere.
Yep. And it's obviously, and I fully admit, it's a relatively short period. So since the end of October of last year, we've generated an annualized return of just under 33% versus our benchmark, which is the S&P 500 core S&P ETF, the IVV, which has returned at annually just under 26%. So we're seeing roughly 7 percentage points annually outperformance against our benchmark. So I would take that over the long term.
Yeah, well, those are some crazy numbers. Those are some great numbers, and so I want to wrap it up with this piece of staying attentive to sell signals, Wayne. Even with a strong conviction of a great model, we know because we have experience, not all seeds grow, even in ideal conditions, and the ego gets involved with people that start to average down and start to sell winners to buy more of a losing, stock is terrible. So I think the approach of having defined sells is super important. Wayne, what you've done is you've held a little master class in magnet today without really going through the magnet factors. And so love what you do, love what you're doing. I'd like to see more of the portfolios. It sounds like I need to go to the premium service. I'm happy to do that. I think that again, I love AAII's approach of education, of both teaching you how to fish and giving you fish as well. I think it's just a great service. It's nonprofit. It's really super reasonably priced. And Wayne, what I'm hoping is to have you on periodically. I have relationships, through AAII. We'd love to bring on senior management to talk about other strategies. And we'd love you to be a regular here on WealthWise. And thanks for your time today.
Thank you, Jordan. I appreciate it. Let me just say, I've read Magnet Investing, and it's one of the best investment texts I've read because how clearly defined your approach is. So thank you very much.
Well, you're making me blush, and what I'll tell you is that listen, people with this really short attention span, you tell them to read a book, and they look at you like, "What is a book?" I've actually have a 4-page article on your site, which probably is one of the clearest summaries of what Magnet Stock Selection's all about. And I tell people, if you don't want to read the book, go to AAII, look up Jordan Kimmel in the box. There's a few articles, but Wayne, I just love what you do. I love this segment, and I want to wish you a great summer. We'll see you for sure pretty soon.
Well, thank you so much for having me on, Jordan. Pleasure talking with you, and I can't wait to come back.
All righty. Well, we've run up against time here. I want to thank Todd, and I want to thank the CrossCheck Media for doing a great job with these videos. And we'll be right back with some more WealthWise soon, with some more super guests, just like Wayne Thorp. We'll see you soon.